There's this thing going around that I've just seen a pickup lately of this sort of short-term rentals. Talk to us about this little STR loophole that I keep hearing about. What is it and why should we care?
Yeah, it's definitely related to what we're saying like most people who invest in long-term rentals, it's like, hey, I'm getting all these tax benefits from write-offs and depreciation, but if I have high income, I can't use it against W-2. And the biggest hurdle is because it's one of the rules is you have to spend more time in real estate than your job. So unless you're, heavily involved in real estate, most people will never overcome that hurdle. And that's where the short-term rental loophole comes in. So in the tax world, if you invest in a short-term rental and you strategically create these losses that we're talking about, right? Paying your kids, writing off your new car that Mauricio is buying. So if you're doing that and it's related to a short-term rental, you can potentially use that loss against your W-2 income or your business income, even if you are not a real estate professional. When it comes to short-term rentals, you only have to meet one of those requirements, which is material participation. So as long as you have material participation in the short-term rentals, now all those losses can offset your W-2 income. And so this works really well for our clients who are high income earners and doing real estate almost like as a side hustle, right? So maybe I have, 1, 2, or 3 short-term rentals. As long as I have enough hours on those, then I can use those losses against my W-2 income and get some pretty hefty tax savings.
This isn't unique to short-term rentals, right? I mean, I've heard this strategy. I'm actually thinking about it, to be honest with you, with something like a laundromat, right? I could buy a laundromat and I could materially participate in that in order to get those benefits. What I've been trying to do is, and I think I figured it out, I just haven't done it, but there's a way, I believe, to do that in the year. So you acquire the property. Let's say this is perfect. We're in November, right? So if I acquired a short-term rental or I acquired a laundromat or something like, or a business like that, and I materially participated this year, which I think might be, I think it's, what is it, like 100 hours more, spending more time than any other employee? Is that the one of the, I know there's several definitions, but is that the easiest one to get?
Yeah, there's actually 3 ways to qualify. So it's either you have 500 hours, or you have 100 hours and nobody else has more time than you, or the third one, which is you spend more time than everybody else combined. And so, yeah, it's really powerful when we talk about year-end planning, because if you bought a laundromat, for example, and you're the only person who's there, you're setting it up, you're just doing everything there is to do, then it's very easy, right? You can meet that third one, which is you have more time than everyone else combined. And then you'll be able to do, depreciation and all that stuff to offset income. So yeah, we see laundromat a lot. Sometimes like convenience store, gas station type of things, we see that. And then yeah, short-term rentals, boutique hotels.
Is it possible, this is a timing issue, but is it possible for me to acquire the laundromat or the short-term rental, let's just say in December? Let's just say I just bust my butt and I work my 100 hours in December. I work more than any other employee. I get all my deductions in for this year. And then next year, I decide to just outsource the whole thing and bring in a management company, and now it becomes completely passive. That counts as passive income to me at that point, right? For next year?
Yeah. And actually for some of our clients, it actually is the best of both worlds, right? So meaning this year, I'm meeting material participation. So it's a regular loss. I get to use it to offset my, law firm income. And next year, fast forward now, theoretically, my short-term rental is very profitable because I have all the systems in place. And I don't have as many write-offs because, I already took all that depreciation in the first year. And so now if it's passive and I happen to have a lot of other passive losses, let's say because I invest in apartment syndications, right? And now I can use my passive losses to offset the passive income on that short-term rental in the subsequent year. So yeah, there's definitely some really great strategies when you're doing multi-year planning, right? Which is kind of what you're describing. What is it like this year? What is it like next year? There's no requirement in the IRS that says this property must remain as a short-term rental. And in fact, if the average guest stay is greater than 7, it automatically is no longer a short-term rental. It's just defined as a long-term rental for tax purposes. But having said that, I will throw out a caveat because I have had investors say this to me, like, what if I just rent it as a short-term rental for 2 days this year, and then immediately it's going to turn into a long-term rental, and I'm just not going to manage anything starting January 1st? That's maybe a little bit risky, right? You don't want to just have the facts shift immediately and so drastically right away. I would still try to operate it, be a little bit more hands-on, at least for the next couple months, and then transition it into something more passive, right? Because again, there's not a requirement that you always keep it active, but we also don't want to have just like a a very fishy thing where it's like 2 tenants and then that's it forever.
So if you enjoyed this clip and you want to see the entire episode, click here. And if you want to see other videos similar to this, click here.